We have started capital gains tax in our last class, and we have learned the calculation of capital gains tax from our last class. And today we are going to cover the remaining areas, next areas. So today we are going to discuss different cases, different situations, and we will learn how to calculate gain or loss in different circumstances, different situations, different scenarios. For example, we have learned in our last class how to calculate gain or loss on disposal of a specific asset. For example, if we have sold an asset, we just need to write down the disposal proceeds, we need to deduct the cost of that asset, and we have capital gain. What if we have not sold the 100% asset? We have not sold the whole asset. We have only sold portion or part of the asset. So how to calculate gain or loss then? We have not sold, for example, I own a plot of land and I'm going to sell 50% portion of the land. I'm still retaining the remaining 50% portion. So how to calculate gain or loss in this situation if I'm not going to sell 100% asset? So students, today we are going to learn how to calculate gain or loss in different situations, in different circumstances. Okay. So in our last class, we have covered the fundamental concepts of capital gains tax, how to calculate the tax. There was one point which was pending, that was payment of capital gains tax. So capital gain tax is due in one amount with the income tax. So we pay income tax and capital gain tax on the same date under self-assessment on 31st January following the tax year. So the deadline to pay the capital gain tax is 31st January after the end of the tax year. For example, if we are considering 1920 tax year, so 1920 tax year will end on 5th of April 2020. And the deadline to pay the tax is 31st January, which is after the tax year, which is 31st January 2021. So this is the deadline to pay corporation tax, which is 31st January after the end of the tax year. So we have learned how to deal with the capital losses. If we have capital loss from any asset, we need to deduct it from the capital gains of the other assets. If we have sold multiple assets during the year, so capital loss of the one asset would be adjusted from the capital gain of the other assets. And still, if you have capital loss, then you can carry forward and deduct from capital gains of the future years. So today, the main topic which we are going to start is chattels. So what are chattels? Chattels are basically tangible and movable assets. Any asset which has physical existence and we can move that asset from one place to another without any alterations, just like your mobile phone. So it is tangible, it is movable, so your mobile phone is a chattel, just like your laptop. So your laptop is a tangible asset and your laptop can be moved from one place to another without any alterations. So it's also an example of chattels. So all those assets which are tangible as well as movable are called chattels. So there are two types of chattels. First of all, non-wasting chattels. Those tangible movable assets whose life is more than 50 years are called non-wasting chattels. For example, whenever the word antique will be used, or jewelry or painting, students, these three examples are given by the tax law. And tax law has mentioned that these three assets will always classify it as a non-wasting asset. Whenever the word antique will be used, whenever the word antique or jewelry or painting will be used, you will assume that the life of these assets is more than 50 years. So these three assets will be classified as a non-wasting chattel. So those tangible and movable assets whose life is more than 50 years are called non-wasting chattels. And those tangible movable assets whose life is less than or equal to 50 years are called wasting chattels. So life more than 50, non-wasting. Life less than 50 years, called wasting chattels. So what are the tax implications? So let's move towards the tax implications. We need to consider their cost and selling price. For example, let's take jewelry as an example. Let's take the example of jewelry. We have purchased the jewelry for less than £6,000 and we are going to sell the jewelry for less than £6,000. So if cost is less than 6,000, selling price is less than 6,000 as well, it will be exempt. Either you have profit or loss. In both cases, it will be exempt. For example, DP stand for disposal proceeds, means selling price. So right now, we are considering non-wasting chattels. So for example, if a non-wasting chattel, just like jewelry, so if the jewelry has purchased for say £4,000 and we are going to sell it for jewelry was purchased for £3,000 and we are going to sell it for £4,000. You can see over here there is a profit of £1,000, but because the cost is less than 6,000, selling price is less than 6,000, so the solution is it is exempt because cost and selling price both are less than £6,000. In the same way, for example, let's take another example. If we have purchased non-wasting chattels for £5,000 and we are going to sell it for £3,200. So now in this case, there is a loss of £1,800, but once again, it will be exempt. Exempt means no tax implications. Either you have profit or loss, in both cases, there will be no tax implications. You're not going to pay tax on the profit, and alternatively, you're not going to get any relief on the loss. Moving forward. So this was the very first case. Cost and selling price both are less than 6,000. So now let's consider the vice versa case. If cost and selling price both are more than £6,000, then there will be normal calculations. So normal calculation means selling price minus cost. Either you have profit or you have loss. If you have profit, you have to pay tax. If you have loss, you will get relief. So these are the normal tax implications. So you will write down selling price, you will deduct your cost, you have profit or loss. If you have profit on sale of asset, you have to pay tax. Alternatively, if you have capital loss, obviously you can deduct that capital loss from profit of the other assets you have sold in the current year. If you have not sold any asset in the current year which have capital gain, you can carry forward your capital loss and deduct it from the capital gains of the future years. Next, if cost is more than £6,000 and selling price is less than £6,000. So obviously, if the cost is more than 6,000 and selling price is less than 6,000, obviously there will be loss. For example, For example, if you have purchased an asset for say £8,000, if you have purchased an asset for £8,000 and you are going to sell it for £3,200, so you can clearly see over here, purchase price is £8,000 and you're going to sell it for £3,200, obviously you have capital loss. But what are the tax implications? What are the tax rules in this situation? Students, tax law says that if you are going to sell a non-wasting chattel, if you are going to sell a non-wasting chattel whose cost is more than 6,000, you can see cost is more than 6,000 and selling price is less than £6,000, in this case, you will ignore the actual selling price. Selling price will be deemed, selling price will be assumed to be £6,000. And then you will deduct your cost, which is £8,000. Now you have capital loss of £2,000. So this is the tax implication. If you are going to sell a non-wasting chattel whose cost is more than 6,000, selling price is less than £6,000. So in this case, selling price will be assumed to be £6,000 instead of actual selling price. In the last case, vice versa. If cost is less than 6,000 and selling price is more than £6,000, so what will happen in this situation? Cost is less than 6,000, selling price is more than 6,000. So what are the accounting implications in this case? For example, if we have purchased an asset for say £4,000 and we are going to sell it for £9,000. So you can see cost is 4,000, cost is less than 6,000. Selling price is 9,000, which is obviously more than £6,000. So how to calculate gain or loss in this situation? So students, in this situation, there are two treatments. One is normal treatment. We need to calculate gain or loss with two methods. Method number one is normal treatment. What is normal treatment? Selling price minus cost is your normal treatment. So in this case, we don't need to assume the selling price. We will take actual selling price. So in this situation, actual selling price is £9,000 and your actual cost in this situation is £4,000 and you have capital gain of £5,000 as per normal calculation. And the second calculation will be formula. There is a specific formula. So in the second situation, we will apply a formula and we will calculate gain or loss with the help of formula. And what is that formula? Formula is 5 by 3 into disposal proceeds minus £6,000. So this is a fixed formula. So 5 divided by 3, bracket start, disposal proceeds, selling price, which is £9,000 in this situation, minus 6,000, bracket close. So in this situation, we will calculate gain or loss with the help of this formula. So now let's solve this formula as well. So fortunately, Fortunately, the answer of this formula is same in both uh, situations. Let me change the selling price a bit so that when you will revise this topic, you will not confuse. Suppose your selling price is 8,500 instead of 9,000 pounds. Yes, it's perfect. So, students, we have applied both these formulas. You can see with the normal calculation selling price minus cost, your answer is 4,500. But with the help of formula 5 by 3 into disposal proceeds minus 6,000, the answer is 4167. So we will calculate gain with the help of these two formulas and we will take the lower value. So 4167, this is the lower value as compared to the other one. So that is lowest tax. So lower value out of these one is taxable. So students, if you have any confusion or if you want to ask anything, you can ask. If you have any question or if you want to ask anything, students, you can ask.
Yeah, mine is not really a question per se, but is all about the concept. So basically, the essence of this is just about applying what the tax rule says.
So now let's move towards wasting chattel. Wasting chattel means those tangible and movable assets whose life is less than 50 years. So please remember, these are exempt. All those tangible and movable assets whose life is less than 50 years are called wasting chattels. And all the wasting chattels are exempt in this capital gains tax. But there is an exception to the plant and machinery. So plant and machinery on which capital allowances has been claimed. So what is capital allowance? The depreciation of an asset calculated as per tax rules is called capital allowance. So we will cover it in the income tax capital allowances. So capital allowances are only available on the plant and machinery. So tax law only allows an alternative to depreciation only on plant and machinery. So we cannot claim capital allowance on any other asset. So there is an exception to plant and machinery. For example, please remember plant and machinery will always be a wasting asset. Means you will always assume that the life of the plant and machinery is less than 50 years. Whenever the word plant and machinery will be used, it means life is less than 50 years. So it's understood. So it is understood whenever the word plant and machinery will be used, it means life of this asset is less than 50 years. So if we have purchased a plant and machinery and now we are going to sell it. So if asset is sold at a profit, if we are going to sell plant and machinery at a profit, we will apply pound 6,000 rules. So what is pound 6,000 rules? We have just learned we need to consider the cost and we need to consider the selling price and we need to treat these assets accordingly. So this is pound 6,000 rule. This table is called pound 6,000 rule. This table in front of you guys. So this table is called pound 6,000 rule. So whenever you are going to sell plant and machinery, you need to consider the cost, you need to consider the selling price, and you need to consider calculation of gain or loss accordingly. So if we have sold plant and machinery at a gain, then we will apply pound 6,000 rule. Alternatively, if we have sold the plant and machinery at a loss, then we will ignore it. So why we are going to ignore it? Because if we have profit, we are going to pay tax. And on the other hand, if we have losses, then we are going to ignore these losses. So logic for this will be covered in the income tax. So when we will cover income tax, relief of loss will be given in the income tax. That's why we are going to ignore the loss over here, because relief will be given in the income tax, not capital gains tax. So the last point is wasting assets, not shackles. Now, we are going to learn those assets which are wasting assets. So, first of all, we are starting with the term wasting assets. Friends, all those assets, all those assets whose life is less than 50 years are called wasting assets. Whenever the term wasting asset will be used, means we are going to discuss that type of asset whose life is less than 50 years. Assets having life of less than 50 years are called wasting assets. And the next term is not chattels. These assets are not chattels. What are the criteria to be satisfied in order to declare an asset as a non-chattel? So there are two conditions for an asset to become chattel. So it should be tangible plus it should be movable. So these assets are not chattels because either these are not tangible or they are not movable. So all the intangible assets are the example of these type of assets. And the second condition is these should be wasting. Means life should be less than 50 years. For example, we have purchased an intangible asset just like copyrights. We are taking example of copyrights. It's an intangible asset. So life of these copyrights is say 30 years. So we have purchased copyrights and the useful life of these copyrights is say 30 years. Or say, for example, we have purchased software as well. So cost, our cost is say 40,000. Disposal proceeds. We have sold these copyrights um, sold after say 5 years. Sold after 5 years and the selling price is say 39,000 pounds. So first of all, we need to learn the topic over here. Life of this asset is 30 years. Means it is a wasting asset. And because it is an intangible asset, copyrights, they don't exist physically. So it's not a chattel. So now we are going to discuss an asset which is intangible, means which is not chattel, and life is less than 50 years. So how to calculate gain or loss? First, we will write down disposal proceeds and then we will deduct allowable cost. How to calculate allowable cost? Total cost into remaining life divided by total. So this is the formula to calculate gain or loss whenever you are going to sell an asset which is wasting asset but not chattel. So now let's calculate it over here as well. Disposal proceeds. Since we have sold this asset for 39,000 pounds. So this is disposal proceeds. And now we need to deduct cost as well. In order to calculate cost, of this asset, first we will write down full cost, which is 40,000 pounds, into the remaining life, which is 25 years, divided by total life, which is 30 years. We are going to sell these intangible assets, these copyrights, after 5 years. So total life is 30 years. We have used these copyrights for 5 years, and remaining life is 25. So equal to 40,000 multiplied by 25 divided by 30. So now you have the answer. So 39,000 pounds minus 33,333. Answer is 5,667. This is your capital gain. Friends, if you have any confusion or if you have any question, you can ask. So in this way, you will be able to calculate gain or loss whenever you are going to sell a wasting asset which is not a check. Moving forward, the next topic which we are going to discuss is part disposal. Part disposal means we are not going to sell 100% assets. Part disposal means we are going to sell only portion or part of the asset. So how to calculate gain or loss if we are going to sell only portion part of the asset and we are not going to sell 100% asset? So the next topic is part disposal. Part disposal. So say, for example, we have purchased, let's take land as an example. So we have purchased land, say 4 hectares. So we have purchased 4 hectares of land and we have purchased it for say 1 lakh. Sold 1 hectare after, so we have sold 1 hectare out of these 4 and we have sold it say for 80,000 pounds. See, and we have sold it say after 7 years. So now at this date, market value of remaining 3 hectares at disposal date so we have total 4 hectares and we are going to sell only 1 hectare, and the market value of the remaining 3 hectares at the date of disposal is say 2,20,000 pounds, or maybe you can say 320. One. Because this is a small example. I'm repeating this example once again. We are taking land as an example. We have purchased 4 hectares of land for 1 lakh pounds, and we have sold 1 hectare after 7 years, and the selling price is 80,000 pounds. The market value of remaining 3 hectares at the date of disposal is 1,20,000 pounds. So let's solve this example. This is called part disposal. Part disposal means we are not going to sell 100% asset. We are going to sell only portion of the asset. So if we will consider the disposal proceeds, we have sold 1 hectare for 80,000. So students, how to calculate cost in case of part disposal. So students, please don't calculate the cost as per the area or as per the number of units, because if we will consider the example of land, obviously the value of the land will vary according to its location. It's not just the area on which market value will depend, it is also the location as well. So that's why please don't calculate the cost as per the area. So how to calculate the cost in case of part disposal? We have a formula to calculate cost in case of part disposal. This is the formula. Formula is total cost, this is your total cost into A over A plus B. And what is A? A is basically market value of the part sold, means selling price. So A is your selling price and B is the market value of remaining assets. So let's apply this formula over here as well. So how to calculate cost in case of part disposal? First, you will write down full cost. What is your full cost? We have purchased 4 hectares of land for 1 lakh pounds. So total cost into selling price. What is your selling price? 80,000 pounds. So total cost into selling price divided by bracket start selling price, which is 80,000 pounds, plus market value of remaining asset, and the market value of the unsold portion is 120,000 pounds. Students, this is the formula. This is the formula to calculate cost. Total cost into selling price divided by selling price plus market value of the remaining asset. So 1 lakh is the cost into selling price, which is 80,000 pounds, divided by once again selling price, which is 80,000 pounds plus 1,20,000 pounds. So let's apply this formula over here as well. Equal to 100,000 pounds multiplied by selling price, which is 80,000 pounds, divided by bracket start, once again selling price, plus market value of remaining asset, which is 120,000 pounds, bracket, which is 40,000 pounds. And how to calculate gain or loss? Selling price minus cost is equal to gain or loss. Here you go. This is your capital G. And now there is an interesting question. What is the cost of unsold portion of asset? What is that? Because we have purchased 4 hectares in total, we have sold only 1 hectare, and we still own 3 hectares. So what is the cost of unsold asset? Students, you can see the total cost was 1 lakh. We have purchased 4 hectares for 1 lakh, minus we have sold 1 hectare, and the cost of that 1 hectare is 40,000 pounds over here. So this is the cost of 1 hectare which we have just sold. So our total cost of 4 hectares was 1 lakh. We have just sold 1 hectare, and the cost of that 1 hectare is 40,000. So this is your answer, 60,000 pounds. So this is the cost of unsold asset, which is 3 hectares of land. So this was a topic of part disposal. In this way, you will be able to calculate gain or loss if you are not going to sell your 100% asset, if you are going to sell only portion of that. Students, if you have any confusion, you can ask. The next topic which we are going to discuss is asset damage. Asset damage means due to some incidents or accident, portion of the asset has damaged. So how to calculate gain or loss in this situation if portion of the asset has damaged? So the main point which you should consider is the disposal, or sorry, insurance proceeds. So you need to decide whether the insurance proceeds have received or not. If the insurance proceeds have received, tax implication will be different. And if the insurance proceeds have not received, tax implications will be different. So asset damaged. First of all, we will discuss the case in which no insurance proceeds have received. So we have sold an asset, and an asset has damaged, and that asset was not insured. So in this case, there will be no tax implication. There will be no calculation. There will be no tax implications at all. If an asset has damaged and that asset was not insured, or no insurance proceeds, your insurance claim was not successful, even though asset was insured, but the insurance claim, unfortunately, the insurance claim was not successful. In both cases, if you are not going to receive anything from the insurance company, in that case there will be no tax implication, there will be no disposal, and there will be no tax implication. But there will be tax implications if you have received the insurance proceeds. So there are two scenarios. If the insurance proceeds have received, then there are two scenarios. First of all, not used to restore the asset. A portion of the asset has damaged. You have received money from the insurance company against that damage, but you have not reinvested your money. You have not used your money for the repairing of an asset, for the restoration of an asset. So how to calculate gain or loss? Simply, it will be treated as part disposal. For example, we have purchased an asset. Suppose we have purchased a painting. So we have purchased an asset costing, say, £10,000. It was damaged, and market value in damaged, the market value of this asset in the damaged form is, say, £8,200. And the insurance proceeds of, say, £3,000 has received but not used for repairing within 12 months. So we have received £3,000 from the insurance company, and we have not used the £3,000 for the repayment purpose. We have kept this money in our pocket. So how to calculate gain or loss in this situation? So the topic is asset damaged, asset damaged. So the asset has damaged, insurance proceeds have received, but we have not used the money for the repairing purpose, for the restoration of an asset. So in this case, it will be treated just like part disposal. So portion of the asset has transferred and you have received money against that portion. So it will be treated just like part disposal. So first of all, we will write down disposal proceeds. First, we have received £3,000 from the insurance company. And how to calculate cost? So we have just learned the formula to find out the cost in case of part disposal. So what is that formula? Students, we will write down full cost. Full cost is £10,000 multiplied by selling price, which is £3,000, divided by selling price, which is £3,000, plus market value of remaining asset. So now we have the remaining asset, which is in damage form, and the market value of that remaining asset is £8,200. First, in this way, you will be able to calculate gain or loss. This is simply the formula of part disposal. So let's apply Excel formula over here as well. So £10,000 multiplied by selling price divided by selling price plus market value of unsold asset. So this is the cost. And this is your capital gain. Alternatively, you may have capital loss as well if the selling price is less. So in this case, you have capital gain of £321. So this was the first case of asset damage in which insurance proceeds have received, but these insurance proceeds are not used for the repairing of an asset. And let's consider another example. For example, we have purchased an asset for £10,000. The asset has damaged, and the market value in the damaged form is £8,200. So insurance proceeds of £3,000 has received, and we have used the insurance proceeds. Insurance proceeds insurance proceeds of £3,000 has received, of which say 2,300 used for repair within 12 months. So this is another scenario. We have received money from the insurance company, and we have used this money for the repairing of an asset, and asset has repaired within 12 months. So this is a compulsory condition. If you want to reinvest your money, you have 12 months from the date of receipt from the insurance company. So the day when you have received your money from the insurance company, you have next 12 months to use that money for the repairing purpose. If you have not used the money you have received from the insurance company for the repairing of an asset within 12 months, it will be assumed that you have never reinvested the money. If you want to reinvest, you have 12 months. So how to calculate gain or loss in this situation? Students, in this situation, option 1 is part disposal. Option number 1. If you want to pay tax immediately, you can pay the tax immediately. So you have option number 1 of part disposal. But you have another option if you don't want to pay tax immediately. So option number 2. So insurance asset has damaged, insurance proceeds has received, and we have used to restore the asset within 12 months. We have used the money which we have received from the insurance company for the repairing purpose. Now, you have one option of part disposal. You can treat it just like part disposal and calculate gain and pay tax. So we have, just like in previous example, we have calculated the gain of £321 with the help of part disposal formula. And in option number 1, we can pay tax on £321 if we want to. And what is option number 2? Option number 2, we can defer, we can delay the gain. How to delay it? So what is option number 2? First, you will write down your total cost. And what is your total cost? Original cost plus repair cost. So this is your total cost. You have purchased this asset for £10,000. You have incurred cost for the repairing, and repair cost is 2,300. So this is basically your total cost. £12,300. So you will write down your total cost, which is 12,300, and you will deduct your disposal proceeds over here. So you will deduct your disposal proceeds. It looks strange, but this is the accounting, the tax implication. What is the disposal proceeds? What is the insurance proceeds? Insurance proceeds are your disposal proceeds. So it's better that I should write down insurance proceeds over here as well. So you will deduct your disposal proceeds money received from the insurance company will be your disposal proceed. So write down total cost, deduct your disposal proceeds, and disposal proceed in this case, money received from the insurance company is £3,000, and there you go. You have £9,300. This is the revised cost. You don't have to pay anything. You don't have to pay any tax. This is the revised cost of the asset. Whenever you will sell this asset in the future, you will use £9,300 as the cost of the asset. That's it. So if you want to delay the gain, you can delay it. So your cost will be reduced. So you can see original cost was £10,000, but now it is showing £9,300. So your cost has reduced. Whenever you will sell this asset in the future, automatically due to reduction in cost, profit will be increased. So this is a simple rule for the calculation of profit. If you want to reduce your cost, your profit will be increased. So we are doing it over here as well. We are reducing our cost in this example. We are reducing our cost. So original cost was £10,000 and now it has reduced to £9,300. So there is a reduction in cost. And whenever we will sell this asset in the future, obviously cost is understated, so profit will be overstated in the future. So right now, we don't have to pay any tax. So you can choose either of the options. But in the exam, always try to delay the tax. So being a student, option number 2 will be your first choice. But practically, option number 1 is possible. It depends upon the data in the question. But if question is silent, you will always choose option number 2. So in the option number 2, you will only calculate revised cost, and in this case, there will be no gain, no loss. Students, if you have any confusion or if you have any question, you can ask. And the last point which we are going to discuss today is asset lost or destroyed. Students, there is difference between asset damaged and asset lost or destroyed. There is difference. Asset damaged means only portion or part of the asset has defected, while in case of asset lost or destroyed, in case of asset lost or destroyed means asset lost, 100% asset has transferred without receiving any consideration. So asset lost means 100% asset has lost, or destroyed means 100% asset, full asset is now defective. For example, maybe due to fire. So due to an accident of fire, whole asset has destroyed. So either in case of theft or lost or destroyed, same tax implications will be applicable. In case of asset lost or destroyed or theft, in all these three situations, these are the tax implications. First of all, no insurance proceeds received. Asset has destroyed, suppose asset has destroyed in the fire, and no insurance proceeds has received from the insurance company. So what will be the accounting implication? For example, asset destroyed. So we have purchased an asset for say cost is £20,000. Cost of an asset is £20,000. It was destroyed, and No insurance proceeds received. Either asset was not insured, or maybe your insurance claim is not successful. So cost of this asset is £20,000. It's destroyed. Suppose maybe destroyed in fire. It was destroyed through fire. And no insurance proceed is received in this situation. So students, what are the tax implications? You will simply write down disposal proceeds. So your disposal proceeds in this situation are zero. You will deduct your cost, and your cost is £20,000. It means you have 100% loss. So you have capital loss of £20,000. And you can deduct this loss from capital gains of the other assets. So this was the first example of asset destroyed case. Moving forward towards another example. In this case, no insurance proceeds received, disposal proceeds are zero. You will deduct your allowable cost and you have capital loss in full. Now, insurance proceeds has received. What will be the tax implications if you have received the insurance proceeds from the insurance company? Now, it depends. You have received money from the insurance company. Now, the tax implication will depend upon your reinvestment. Either you have reinvested your money to purchase another asset, or you have kept the money in your pocket. So, insurance proceed received, you have received money from the insurance company and no replacement of an asset. You have not purchased another asset from that money. So in this situation, normal CGT calculations. Money received from the insurance company will become your selling price. So say insurance proceeds of insurance proceeds of £23,000 has received and not used to purchase new asset, to purchase new asset within 12 months. So this is a small example. We have received £23,000 from the insurance company and we have not used this money to purchase a new asset. So now, in this case, students, you have received £23,000 from the insurance company and you have not reinvested your money. So now you have capital gain of £3,000. £3,000. So you have to pay tax on this £3,000. And that's it. So this was the second case of asset destroyed. You have received money, but you have not used this money to purchase the new asset. Next one. Now, let's move towards the next case. Insurance proceeds has received. We have received money from the insurance company. The replacement of an asset within 12 months. So asset has destroyed in fire. We have received money from the insurance company and We have used the money to purchase a new asset within 12 months. So once again, there are two scenarios. Either you have fully reinvested or partially reinvested. So first of all, we are going to discuss the case of full reinvestment. So asset has destroyed, money has received from the insurance company, and there is full reinvestment of insurance proceeds. Full reinvestment of insurance proceeds. So we have purchased an asset for 20,000 pounds. If the asset was destroyed in fire, 100% asset has destroyed. Insurance proceeds of 23,000 pounds has received, of which of which mm, and new asset purchased for 24,000 pounds within 12 months. We have purchased an asset for 20,000 pounds. This asset was destroyed in fire, and because this asset was insured, so we have received 23,000 pounds from the insurance company. And we have fully reinvested our money, even though we have reinvested 1,000 pounds extra from our own pocket. Not only we have reinvested 100% insurance proceeds, but on top of that, we have invested 1,000 pounds out of our own pocket as well. How to calculate gain or loss in this situation? So in this situation, we have reinvested 100% disposal proceeds. Students, disposal proceeds. We have received 23,000 pounds from the insurance company. Cost is 20,000 pounds, and we have capital gain of 3,000 pounds. And we have purchased a new asset as well. And the cost of the new asset is 24,000 pounds. So in case of full reinvestment, you can see full reinvestment means there is a confusion. Normally, students think that full reinvestment means we need to reinvest the full amount of the capital gain. Please remember, reinvestment means reinvestment of insurance proceeds. We have received 23,000 pounds from the insurance company, and we have purchased a new asset for 24,000 pounds. So we have fully reinvested the amount received from the insurance company. So in case of full reinvestment, students, you can delay your full gain. It is called gain rollover. Rollover means delay. Gain rollover. So you can delay your gain, you can roll over your full gain. So your chargeable gain is zero. You don't have to pay any tax right now. But the gain rollover will be deducted from the cost of the new asset. So this is called revised or base cost of the new asset. Revised or base cost. Whenever you will sell this asset in future for the cost will be 21,000 pounds. Right now, you have no gain. But whenever you will sell this asset in the future, you will use 21,000 pounds as a cost. So cost has reduced. So we have understated, we have reduced the cost. So as a result of reduction in cost, whenever we will sell this asset in the future, our profit will be increased. So it is just common concept. Whenever the cost will be decreased, whenever the cost will be decreased, profit will be increased. Students, if you have any confusion, you can ask. So this was the case of full reinvestment. So in case of full reinvestment, there will be no gain, no loss. Insurance proceeds will become your selling proceeds. You will deduct your cost. You have capital gain. Your gain will be rollover. Your gain will be deferred. And this rollover gain will be deducted from the cost of newly purchased asset. And the last point is partial reinvestment. What if you have not reinvested your 100% amount? If you have kept portion of the insurance proceeds in your pocket. So what would be the tax implications in that case? For example, insurance proceeds of 23,000 pounds received, a new asset was purchased for say 22,500 pounds. So this is called partial reinvestment. This is not full reinvestment. We have received 23,000 pounds from the insurance company. We have received 23,000 pounds from the insurance company, and we have purchased the new asset for 22,500 pounds. So it means we have kept 500 pounds in our pocket. So how to solve this example? So students, in this example, you can see insurance proceeds will become our selling price. We have received 23,000 pounds from the insurance company. Cost of this asset is 20,000 pounds. We have capital gain of 3,000 pounds, and we have purchased the new asset for 22,500 pounds. So students, in this situation, we need a working over here. So what is that working? So working will be for the chargeable gain. Chargeable gain will be lower of. So chargeable gain will be lower of number one. Number one is your actual gain. What is your actual gain? We have calculated above. This is your actual gain. This is your total gain. Number two, insurance proceeds not reinvested. So as you can see, we have received 23,000 pounds from the insurance company, and we have purchased the new asset for 22,500 pounds. So we have not, the amount which has not reinvested means the amount which we have kept in our pocket is 500 pounds. And what is the lower value? Since you can see, obviously 500 pounds is the lower value. So 500 pounds is chargeable over here. So this is your chargeable gain. So chargeable gain from working 1 equal to this 500. And gain rollover, gain deferred, gain delayed will be your balancing amount. Balancing. So total gain is 3,000 pounds minus you have to pay tax on 500 pounds. It means the gain which will be deferred is 500 pounds. And the gain which will be deferred, which is 2,500, will be deducted from the cost of the new asset. The cost of the new asset is 22,500. So gain deferred will be deducted from the cost of the newly purchased asset. So the revised cost or base cost of the new asset is 20,000 pounds. Whenever you will sell the new asset in the future, you will take 20,000 pounds as the cost of the asset. So students, if you have any confusion, you can ask.